Hello students, welcome to the lecture on reinsurance, and after this lecture we will be able to learn the following objectives. Describe the kinds of reinsurance, discuss the building relationships key to success of insurance services, explain the distribution channels in insurance, discuss the life insurance is sold not bought, understand the ethics of insurance distribution and issues in India. Define ethical issues in insurance. Let's start with the concept of reinsurance. Reinsurance is governed by the same principles as for insurance. But instead of covering property or casualty risks directly, the insurer insures insurance organizers. Reinsurance spans the diversity of situations specific to each type of insurance and is consequently more complex and much broader in range since it covers the whole world. An insurance organization issues contracts called policies. The insurance organization is the direct or primary insurer of an individual or a business. The policy is written in its name, making it liable for all claims arising under the policy. The insured deals exclusively with the insurance organization. But the insurance organization spreads its risks arising under the policy by transferring all or part of those risks to one or more reinsurance organizers. In reinsurance jargon, the insurance organization is referred to as the ceding organization. In the financial sphere, most countries have enacted laws on the minimum ratio of capital to retained premiums needed to transact business. The ratio is referred to as the solvency margin. It means that a dynamic but narrow capital-based insurance organization must rely heavily on reinsurance in order to grow. Reinsurance can in some instances play a more direct role in financing insurance organizers. In life insurance, for example, considerable outlays are required to build up marketing outlets and other facilities needed when new types of policies are first issued. Under a proportional treaty, the reinsurer and ceding organization share the premium and losses proportionally. If an insurance organization, for example, takes out a proportional cover for 40% of its portfolio, and if the claims amount to a total of 3.5 million francs, the insurer pays 60% or 2.1 million francs and the reinsurer the remaining 40% or 1.4 million francs.
Risk. There's been a lot of questions about what it is.
Please stay with us to learn more about the significant risk to the U.S. Treasury as billions in U.S. tax dollars are siphoned off by foreign-owned insurers into offshore tax havens every year.
Well, living your life and running your business involves some risk. And to minimize that risk, you need insurance. Business insurance, home insurance, catastrophe insurance. There are all kinds of insurance.
Clever graphics would be better if they included a map that shows where foreign-owned insurers hide their profits.
Like their customers, insurance companies have to buy insurance to manage their risk. And to keep prices competitive and the market stable, insurance companies actually share their risk with reinsurance companies. Reinsurers are companies that help keep your insurance premiums low.
We agree, but only with respect to third-party reinsurance, which plays a valuable role in the U.S. market. Our objection lies with reinsurance transactions with affiliates, which do not add additional capacity to the market. These transactions allow foreign-owned insurers to strip profits overseas into tax havens to avoid paying their fair share of U.S. taxes.
By absorbing and managing some of this risk. By spreading the risk around the world, insurance companies don't become overexposed and can provide consumers with more insurance at lower prices, all thanks to reinsurers. But a bill in Congress is threatening to change this. H.R. 3424 would attack this necessary risk-sharing function by levying a new tax on these global reinsurers.
This is not a new tax on foreign reinsurers. The legislation merely would close a loophole that allows the U.S. subsidiaries of foreign-owned insurance groups to avoid taxes that apply to all U.S. companies. Many of these foreign reinsurers are former U.S. companies that moved overseas to avail themselves of this loophole and avoid paying tax.
But what the proposal doesn't mention is that it would also cut insurance availability and raise the cost of your insurance.
Not true. Do not buy into the opponent's scare tactics. Foreign-owned insurers collectively provide less than 2% of homeowners insurance in all coastal states. The legislation will have virtually no effect on capacity or pricing for catastrophic coverage. Taxes are already built into the price consumers pay. Foreign-owned insurers just get to pocket the extra profits.
An independent expert even calculated the annual cost to consumers, like you and me, would be $10 to $12 billion.
This is simply false. This legislation will actually benefit tax-paying consumers by recapturing an estimated $17 billion of revenue for the U.S. Treasury. At a time of burgeoning federal deficits, it is wrong to continue to allow foreign-owned insurers to avoid U.S. tax on their U.S.-based business while American consumers and businesses face tax increases.
No wonder some of the bill's supporters admit the measure could have unintended consequences. Reinsurers here in the U.S. and from around the world also provide the capital needed to insure our country against catastrophic events like terrorism and natural disasters such as tornadoes, earthquakes, floods, and wildfires.
Third-party reinsurers will continue to provide needed capital for catastrophes, and there will be no adverse impact on catastrophic claims-paying ability as a result of this legislation.
Did you know that after September 11th, international reinsurers paid 64% of the $26.8 billion in related claims to help rebuild and repair New York? And along the Gulf Coast, foreign reinsurers are essential after catastrophic events. Foreign insurers and reinsurers paid more than 60% of the $59 billion in loss payments for Hurricanes Wilma, Rita, and Katrina.
The statistics cited regarding claims paid after Wilma, Rita, and Katrina all involve third-party reinsurance transactions, which are not affected by this legislation. Thus, these statistics, while laudable, are irrelevant.
Let us now discuss the kinds of reinsurance. Reinsurance is basically a form of coverage intended for insurance providers. Generally speaking, this type of policy reduces the losses sustained by insurance companies by allowing them to recover all or part of the amounts they pay to claimants. Reinsurers help insurance providers avoid financial ruin in case a huge number of policyholders turn out to make their claims during catastrophic events. There are some of the major types of reinsurance policies. Facultative coverage. This type of policy protects an insurance provider only for an individual or a specified risk or contract. If there are several risks or contracts that needed to be reinsured, each one must be negotiated separately. The reinsurer has all the right to accept or deny a facultative reinsurance proposal. Reinsurance treaty. Unlike a facultative policy, a treaty type of coverage is in effect for a specified period of time rather than on a per risk or contract basis. For the duration of the contract, the reinsurer agrees to cover all or a proportion of the risks that may be incurred by the insurance company being covered. Proportional reinsurance. Under this type of coverage, the reinsurer will receive a prorated share of the premiums of all the policies sold by the insurance company being covered. Consequently, when claims are made, the reinsurer will also bear a portion of the losses. The portion of the premiums and losses that will be shared by the reinsurer will be based on an agreed percentage. In a proportional coverage, the reinsurance company will also reimburse the insurance company for all processing, business acquisition, and writing costs. Also known as ceding commission, such costs may be paid to the insurance company upfront. Non-proportional reinsurance. In a non-proportional type of coverage, the reinsurer will only get involved if the insurance company's losses exceed a specified amount, which is referred to as priority or retention limit. Hence, the reinsurer does not have a proportional share in the premiums and losses of the insurance provider. The priority or retention limit may be based on a single type of risk or an entire business category. Excess of loss insurance. This is actually a form of non-proportional coverage. The reinsurer will only cover the losses that exceed the insurance company's retained limit. However, what makes this type of contract unique is that it is typically applied to catastrophic events. It can cover the insurance company either on a per occurrence basis or for all the cumulative losses within a specified period. Now moving on to the next topic. Now we will study the building relationships key to success of insurance services. The customer acquisition strategy. The way a prospective customer is briefed about a product that he buys and information on the channels available to interact with the insurer for all his future needs. The customer acquisition strategy. The way a prospective customer is briefed about a product and he buys information on the channels available to interact with the insurer for all his future needs determine the basic framework for a long and mutually beneficial experience and relationship for a policyholder. Buying life insurance is just the beginning. Subsequent interactions may go even beyond generations and even life. Such a relationship, therefore, must have a strong foundation. In the business of life insurance, factors like knowledge shared at the beginning, dynamics of evolving needs of customers over a period of time, and commitment to fulfill promises when the moments of truth arise contribute to building such a foundation. How to treat and retain the customers thus acquires greater significance than how to acquire customers. Life Insurance Corporation has done exceptionally well in empowering its intermediaries to render doorstep service to the customers. This is the secret of LIC's wonderful reach even in the remotest areas of the country, and this is reinforced by the fact that it has regained its market share in the worst of times for the industry. In the November 2011 IRDA journal, the chairman remarked that in insurance, the deal is closed between parties who are unequal in understanding and strength. One side has all the knowledge and information, but the other side has only a need that also he may not fully realize. The insurers willing to treat customers fairly need to put in place a system that does not exploit the aforesaid inequality only for chasing short-term goals of raising the top line. Let's know the meaning of distribution channels in insurance. An insurance cover is an intangible product evidenced by a written contract known as the policy. Insurance market various insurance covers either directly or through various distribution channels: individual agents, corporate agents, and brokers. The marketer in the distribution network is in direct interface with the prospect and the customer. Life insurance products are sold through individual agents, and many of them have this as their only career occupation. General insurance products are sold through individual agents, corporate agents, and brokers. Distribution channels such as agents are licensed by the RDA. To get an agency license, one has to have certain minimum qualifications, practical training in insurance subjects, and passes an examination conducted by Insurance Institute of India. IRDA regulations on licensing of agents brokers lay down the code of conduct for individual agents, corporate agents, and brokers. A separate note on the code of conduct is appended to this note. Insurance agents. Every insurance agent shall identify himself and the insurance company of whom he is an insurance agent. Disclose his license to the prospect on demand. Disseminate the requisite information in respect of insurance products offered for sale by his insurer and take into account the needs of the prospect while recommending a specific insurance plan. Disclose the scales of commission in respect of the insurance product offered for sale if asked by the prospect. Indicate the premium to be charged by the insurer for the insurance product offered for sale. Explain to the prospect the nature of information required in the proposal form by the insurer and also the importance of disclosure of material information in the purchase of an insurance contract. Corporate agent. Every licensed corporate agent shall abide by the code of conduct specified as every corporate agent shall be responsible for all acts of omission and commission of its corporate insurance executive and every specified person. Ensure that the corporate insurance executive and all the specified persons are properly trained, skilled, and knowledgeable in the insurance products they market. Ensure that the corporate insurance executive and the specified person do not make to the prospect any misrepresentation on policy benefits and returns available under the policy. Ensure that no prospect is forced by an insurance product. No corporate agent, corporate insurance executive, specified person shall solicit or procure insurance business without holding a valid license certificate. Induce the prospect to omit any material information in the proposal form. Induce the prospect to submit wrong information in the proposal form or documents submitted to the insurer for acceptance of the proposal. Behave in a discourteous manner with the prospect. Interfere with any proposal introduced by any other specified person or insurance intermediary. Offer different rates, advantages, terms and conditions other than those offered by his insurer. Insurance broker. Every insurance broker shall follow recognized standards of professional conduct and discharge his functions in the interest of the policy holders. Conduct in matters relating to client's relationship. Every insurance broker shall conduct its dealings with clients with utmost good faith and integrity at all times. Act with care and diligence. Ensure that the client understands his relationship with the broker and whose behalf the broker is acting. Treat all information supplied by the prospective clients as completely confidential to themselves and to the insurers to which the business is being offered. Take appropriate steps to maintain the security of confidential documents in their possession. Conduct in matters relating receipt of remuneration. Every insurance broker shall disclose whether in addition to the remuneration prescribed under these regulations, he proposes to charge the client, and if so, in what matter. Advise the client in writing of the insurance premium and any fees or charges separately and the purpose of any related services. Conventional wisdom is that insurance is sold, not bought. Many people claim that insurance products, especially life insurance, are complex, easily misunderstood, need detailed medical data to be underwritten, and therefore have to be sold to customers. The insurance sector has operated over the past 2 centuries with a large intermediary agent force, both captive and independent. that carriers have relied on to build trust with consumers, understand their needs, and eventually sell those insurance products. This means that the insurance sector has a high cost base due to commissions to independent agents and or the cost of acquiring and maintaining a captive agent force, complex processes and rules for underwriting and opaque pricing.
What is life insurance? Life insurance provides a tax-free lump sum payment to your chosen beneficiaries or estate upon death. It covers death of any kind and is designed to protect and secure your family's future in an unfortunate event. The required level of insurance is generally determined by your level of debt and also the number and age of any dependents that you have. There is a complimentary funeral advancement benefit as well as an advance payment if you are diagnosed with a terminal illness. The amount insured can also be automatically increased with inflation each year at your discretion. Your insurance policy will have free interim cover in place as soon as your application has been submitted to the insurance company, immediately protecting you against any accidents.
Advances in technology, mobile devices, social media and networking, cloud computing, big data and smart analytics are some of the technologies that are transforming consumers and advisor expectations and how insurance carriers respond to them. Mobile devices, social media and online networking are enabling consumers to obtain information whenever and wherever they want, often in entertaining and engaging formats. In addition, consumers are increasingly reaching out to their broader virtual social networks for education and advice. Consumer behavior technological change accelerating and as evidenced by the enthusiastic adoption of smartphones and tablets, so is consumer adoption of new technologies. Changing role of advice. In light of changes in consumer behavior, the role of insurance advisors and more broadly independent financial advisors is changing. They are no longer the sole authorities on financial matters and are now one source of information among many within a broader trust network of friends, families, and online advisors. Tangible goods like soaps, toothpastes, furniture, land, building, etc. are demanded by people. Life Insurance Corporation of India and General Insurance Corporation and also private insurance companies is extensively used the service of agents on the following grounds. Insurance is a concept that has to be explained and its usefulness clarified personally to the people. Each prospective buyer has its own special needs and requires specialized solution. Personalized guidance is possible when there is a face-to-face contact between the agent and the customer. Insurance is like sand when it is bought and gold when it is realized. Given a choice, people would postpone the decision to buy insurance as they do not realize its benefits at the time it is offered. They have to be convinced. Focus on multi-distribution channels. A multi-channel strategy is better suited for the Indian market to tap the vast untapped potential. Apart from geographical spread, the socio-cultural and economic segmentation of the market is also very wide. The needs and traits of people are different. Ethics in insurance. The foundation of insurance contract is based on integrity, trust, and expectation that the insurer will pay the amount which was promised to be paid and in the manner understood by the insured. Measures to overcome unethical practices. Imparting training of ethics to the agents. Aligning the organizational culture to ethical behavior. A major ethical issue confronting the Indian insurances and regulators is the rebates offered by the agents to the customers. The commission structure of agents is largely responsible for the same, where first-year commission is as high as 40%. Insurance agents are capable of giving rebates to the customers on first sale out of their commission in anticipation of the expected renewal commissions every year. This can be considered unethical mainly on two grounds. First, it resists the concept of an agent acting as a financial consultant. For example, an insurance agent may advise the potential customer to buy a life insurance policy, whereas an investment in mutual fund or pension fund would have been a better option as per the age and income of the customer. This results in loss of value creation for the customer. The central ethical issue in the insurance industry centers around money over customer support. Several facets differentiate those who see insurance as a vocation and those who view the profession as a means to a financial end. If an insurance agent enters into the profession without a strong ethical foundation, he may quickly discover that people would rather not do business with him. Issues of honesty. Honesty in the insurance industry plays a central role in continued success and growth. A single dishonest act by an insurance agent can be spell doom for his business career and taint his reputation for years to come. Insurance agents and agencies must look at the value of selling clients effective policies that may not net as large a return over selling them unnecessary coverage for short-term financial gains. An insurance agent must decide whether he wants to dishonestly chase the money or treat his clients with honesty and respect. Customer versus client. An insurance agent in the business solely for monetary gain is nothing more than a mercenary. These individuals often look at those who purchase policies with them as customers, mere purchasers of goods and services. Now in the end, let us summarize what we have learned in this lecture. Most countries have enacted laws on the minimum ratio of capital to retained premiums needed to transact business. For the duration of the contract, the reinsurer agrees to cover all or a proportion of the risks that may be incurred by the insurance company being covered. Buying life insurance is just the beginning. Subsequent interactions may go even beyond generations and even life. An insurance cover is an intangible product evidenced by a written contract known as the policy. The insurance sector has operated over the past 2 centuries with a large intermediary agent force that carriers have relied on to build trust with customers.